Let's talk about robo-advisors. Do you need one? You're gonna learn today. What's up, guys, and welcome to Centsible Capital. My name's Jake, and I'm going to explain exactly what you need to know about robo-advisors. By the end of this video, you'll not only know what they are, but if using one is right for you. Before we get into the details, let's take a quick detour to talk about financial management. Generally, there are two ways to invest your money: by yourself or with the help of an advisor. Now, traditionally, getting the help of an advisor is something that's been limited to people with a pretty significant sum of money set aside. And the rest of us, we've been left to handle things all on our own. As brokerage firms have fought to lure in new clients and increase their market share, they've recognized a huge gap in the market. Enter the robo-advisor, a low-cost, digital method of helping people invest their money, and best of all, it's automated. Robo-advisors seek to automate some of the most tedious tasks for investors and advisors alike, such as portfolio rebalancing and tax loss harvesting. To do this, they use algorithms that are usually based on modern portfolio theory. Keep in mind that each and every robo-advisor is different, and the ratio of algorithmic to human decision-making can vary. Now, wealth managers have been using tools to help automate portfolio management since the early 2000s, but it wasn't until Betterment came around in 2008 that we had our first full-fledged robo-advisor. Betterment recognized that a massive amount of people who didn't have enough money to get the attention of a traditional advisor still needed help investing, and they moved to fill that gap. For brokerages and wealth managers, robo-advisors represented a cost-effective and time-efficient way to offer their services to a much wider range of people. On the other hand, for investors, robo-advisors represented their first real opportunity to get real financial advice from someone other than their cousin at Thanksgiving dinner. And just like that, investors had a solution that would solve all of their financial problems for years to come. Not so fast. There's more to the story. Robo-advisors are, at the end of the day, a product. An investment product, yes, but still a product. And like other products, you generally get what you pay for. With a product that costs less than using a traditional financial advisor, you shouldn't expect to receive the same level of service. For example, someone with a traditional advisor could schedule a meeting in person to build a plan to finance their kids' college. Someone with a robo can't expect to do this. So now let's take a look at some of the key differences between robo-advisors and traditional advisors. The most apparent difference between the two is cost. Robo-advisors cost far less than a traditional advisor, with annualized management fees typically ranging between 0.2 and 0.6%. On the traditional side, fees can range drastically depending on the services being provided, but you can safely expect to spend at least 1% of the assets being managed. To make this easier to visualize, let's take a look at an example where you want $10,000 invested. A 0.2 to 0.6% management fee on $10,000 would equate to roughly $20 to $60 per year, or roughly $1.67 to $5 per month. On the other hand, a 1% fee would equate to $100 per year, or roughly $8.33 per month. Another big difference is the amount of money you need to have to get started with each. On the robo side, the minimum dollar amount to get started will range from around $0 on the lower end to $10,000 on the higher side. But typically you'll find that it's between $0 and $5,000 you'll need to get started. On the other hand, traditional advisors will often require that you have at least $100,000 to $500,000 in investable assets before they'll even consider working with you. Keep in mind that some advisors structure their fees differently, so these figures can differ drastically in either direction. Next, we have the setup process. Getting started with a robo is incredibly easy. It's one of their biggest selling points and advantages to investors. The process is as simple as going online to the robo of your choosing, filling out a quick questionnaire to get an idea of your goals, risk tolerance, and timeline, and then funding the account. The whole thing can be done in less than 10 minutes. The process of getting started with a traditional advisor requires much more effort. This typically starts with setting up an over-the-phone or in-person meeting, and they might still require that you fill out a preliminary questionnaire beforehand. These meetings are typically far more personalized in nature and allow you to get a good feel for the person who could be managing your money for years to come. They'll speak to you in detail about your goals, your plans, what's important to you, and hopefully put forth a much more detailed plan than a robo. Yet another important difference lies in the ongoing management of each. After the initial setup of a robo, there's very little, if any, work required on your part. They'll probably require that you complete a brief review online every 6 months to a year or so, just to make sure that things are still aligned with your goals. But outside of that, you shouldn't expect much communication. Traditional advisors will similarly require that you complete a review every 6 months to a year, but these reviews will be much more detailed in nature and typically involve a lot more input on your part as well. Because of this, traditional advisors are much more well equipped to adapt to your changing priorities than a robo is. Lastly, our final key difference lies in investment strategy. Robos almost exclusively utilize ETFs when building a portfolio for you, with some mutual funds occasionally sprinkled in. This helps them passively manage your portfolio in the most time-efficient way possible. You won't find things like stocks or options in a robo portfolio. On the other hand, traditional advisors deploy a much wider range of investment strategies and tools. This allows them to tailor a portfolio much more specifically to your wants and needs. An advisor can even tailor portfolios based on your preferences after you speak with them if you say do or don't like a particular stock that you're holding. This is an area that many people don't fully understand until they're actively using a robo-advisor. You can't call them up and tell them to add or get rid of a specific investment in that portfolio. There are usually a select handful of potential portfolios that a robo provides, and they don't have the ability to stray from those. So don't be surprised when you call up the support line for your robo-advisor and find that they either can't or won't make the changes that you want in your portfolio. So now that you have a better idea of what a robo-advisor is and how it compares, let's talk about if it would be right for you. A robo-advisor is ideal for someone who's short on time and knows very little about investing. It would be ideal for someone who doesn't have a large amount of investable assets, and also who doesn't have a complex financial situation that would benefit from the help of a traditional advisor. For example, let's say that you're fresh out of college, just got your first real job in your career, but you don't have too much money saved up just yet. You know that you need to get started investing, but you have not the slightest clue where to actually get started. A robo-advisor could be a great fit for you. That being said, robo-advisors are not built with everyone in mind, and there are plenty of people who should not be using them. If you have a large amount of money set aside and a more complex situation, say your own business, a few kids, several investment properties, robo-advisor probably isn't the right route for you to take. Also, if you're someone who has a fair amount of investing knowledge, a robo-advisor probably isn't even necessary. With some research and a bit of effort, even with no money at all set aside, you could begin to take steps to build a portfolio that rivals that of the robos, all on your own in a self-directed account. This would effectively save you the extra fees and allow you ultimate control over your investments at any given point in time. It would require some extra work and knowledge to do things on your own, but it's well worth the effort if you have the time and desire to learn. One tip to keep in mind is that you're not locked into any one method. Plenty of people have one account managed by a robo-advisor while they do some trading of their own in a self-directed account. There are tons of potential options, and what makes sense for you now could change in the coming years. Regardless of which option you choose, you owe it to yourself to understand exactly what you're getting into. So take the time, do the research, and watch more of my videos.